What if decisions made in global carbon markets were quietly raising your electricity bill, influencing your mortgage rate, and reshaping your investment portfolio, all without you noticing? Right now, across the United States, carbon credits and green initiatives are no longer distant environmental ideas. They are becoming financial mechanisms that directly affect how much Americans pay for energy, transportation, housing, and everyday goods. This matters now because these policies are accelerating at the same time Americans are already dealing with inflation pressure, higher interest rates, and rising cost of living. Understanding how carbon credits connect to your wallet is no longer optional. It is becoming a necessary part of financial awareness in the modern U.S. economy. What is happening and why it matters? Over the past decade, the United States and much of the developed world have moved toward policies designed to reduce carbon emissions. These policies include carbon pricing, emissions trading systems, renewable energy mandates, and sustainability incentives. At the center of many of these systems is the concept of carbon credits. A carbon credit represents the right to emit a specific amount of carbon dioxide or equivalent greenhouse gases. Companies that exceed their emission limits must purchase credits, while companies that reduce emissions can sell them. From a financial perspective, carbon credits function like a new commodity market. Prices fluctuate based on regulation, supply, demand, and economic activity. What makes this important for Americans is that the cost of carbon does not stay contained within corporations, it moves through the economy. It affects energy prices, transportation costs, manufacturing expenses, food prices, housing construction, and investment flows. This video will break down how carbon credits and green initiatives are influencing the U.S. economy, how they impact inflation and interest rates, what they mean for stock and housing markets, and how American families, workers, investors, retirees, and small businesses are affected in real terms. Understanding carbon credits in financial terms. To understand the financial impact, carbon credits must be viewed not as environmental tools, but as economic instruments. When a cost is added to carbon emissions, it becomes a cost of doing business. Energy producers, manufacturers, airlines, shipping companies, and agricultural firms must either reduce emissions or pay for credits. Those costs are rarely absorbed permanently by corporations. Over time, they are passed through to consumers in the form of higher prices. In financial markets, carbon credits also attract institutional investors. Hedge funds, asset managers, and corporations trade carbon credits as speculative or hedging instruments. This adds volatility and financial complexity to the system. As carbon markets grow, they become more interconnected with broader financial markets, including equities, commodities, and currencies. Impact on the U.S. economy. Carbon pricing and green initiatives introduce a structural shift in the U.S. economy. Capital is increasingly redirected toward renewable energy, infrastructure upgrades, electric transportation, and energy efficiency technologies. This reallocation of capital creates winners and losers. Industries tied to fossil fuels face higher costs and regulatory pressure. Renewable energy companies, battery manufacturers, and clean technology firms see increased investment and government incentives. From a macroeconomic perspective, these shifts can reduce efficiency during transition periods. When energy costs rise faster than productivity gains, economic growth can slow. At the same time, large-scale investment programs can stimulate certain sectors, creating pockets of growth, even while other areas struggle. This uneven impact is critical for understanding future economic volatility. Effects on inflation. Inflation is one of the most immediate channels through which carbon policies affect American households. When energy producers face higher costs due to carbon pricing, electricity and fuel prices tend to rise. Energy is a core input for nearly every sector of the economy. Higher energy costs increase transportation expenses, manufacturing costs, and food production prices. These increases ripple through supply chains and show up in consumer price indexes. Even modest increases in energy costs can have outsized effects on inflation because energy is embedded in almost every product and service Americans consume. During periods of already elevated inflation, additional cost pressures can make price stability more difficult to achieve. This creates challenges for monetary policy and household budgeting alike. Interest rates and monetary policy implications. The Federal Reserve focuses heavily on inflation when setting interest rates. If carbon-related policies contribute to sustained inflation pressure, interest rates may remain higher for longer periods. Higher interest rates affect mortgage costs, auto loans, credit cards, and business financing. This directly impacts consumer spending and investment activity. For home buyers, higher mortgage rates reduce affordability. For businesses, higher borrowing costs can delay expansion and hiring decisions. From a financial planning perspective, carbon policies indirectly influence interest rates by shaping inflation dynamics. This connection is often overlooked but highly significant. Stock market impact. The stock market reflects expectations about future earnings, costs, and economic conditions. Carbon credits and green initiatives are changing these expectations across multiple sectors. Energy companies face increased regulatory risk and cost uncertainty. Some traditional energy firms adapt by investing in renewables, while others struggle to maintain profitability. Technology, renewable energy, and infrastructure firms often benefit from increased government spending and private investment. This can lead to valuation expansion in certain sectors. However, rapid capital inflows can also create speculative bubbles. Investors chasing green trends without understanding fundamentals risk overpaying for growth that may not materialize as expected. Broad market indices may experience increased volatility as investors reassess long-term profitability across industries. Housing market impact. Housing is another area where green initiatives quietly affect American finances. Energy efficiency standards increase construction costs for new homes. While these upgrades may reduce long-term utility bills, they raise upfront prices. Higher construction costs combined with higher interest rates can reduce housing affordability, particularly for first-time buyers. Existing homeowners may face costs related to retrofitting properties to meet new efficiency standards, especially in regions with aggressive sustainability policies. For real estate investors, these changes alter risk assessments and return calculations.
Jobs and wages. The transition towards green initiatives reshapes the labor market. Renewable energy and infrastructure projects create new jobs, often requiring specialized skills. These positions can offer competitive wages, but may not be located in the same regions as traditional energy jobs. Workers in fossil fuel industries may face job displacement or wage pressure. Retraining programs exist, but transitions take time and are not always seamless. From a wage perspective, higher energy costs can reduce real purchasing power even if nominal wages rise. This is especially important for lower and middle-income households. Real-life impact on American families. For American families, the financial impact is often indirect but persistent. Higher electricity bills, higher gasoline prices, increased food costs, and more expensive housing all contribute to household budget strain. Families with fixed incomes, such as retirees, are particularly vulnerable to rising costs. Even small increases in expenses can erode purchasing power over time. At the same time, families with investment exposure to renewable energy or green infrastructure may benefit from market trends. The outcome depends heavily on financial positioning. Impact on investors. Investors face both opportunity and risk. Carbon markets, renewable energy stocks, and sustainability-focused funds attract capital. However, regulatory changes can quickly alter profitability assumptions. Diversification becomes critical.
Over-concentration in any single theme increases exposure to policy shifts and market corrections. Understanding carbon credits as a financial asset class rather than a moral investment is essential for managing risk. Small businesses and entrepreneurs. Small businesses often feel the cost impact more acutely than large corporations. Higher energy and transportation costs reduce margins. Unlike large firms, small businesses have limited ability to hedge or pass costs forward. Compliance costs related to reporting and efficiency upgrades can also strain resources. Businesses that adapt early by improving efficiency may gain a competitive advantage, but the transition requires capital and planning. What may happen next? Looking ahead, carbon markets are likely to expand and become more sophisticated. Price volatility is expected as regulation evolves and market participation increases. Inflation pressures tied to energy costs may persist, influencing interest rate policy. Investors will continue to reprice assets based on long-term sustainability assumptions, creating both opportunities and mispricing risks. For households, financial resilience will depend on budgeting discipline, energy efficiency awareness, and thoughtful investment strategy. Risks to watch. The primary risks include regulatory uncertainty, market volatility, and unintended economic consequences. Rapid policy shifts can disrupt markets. Poorly designed systems may increase costs without delivering proportional benefits. Financial literacy around these topics remains low, increasing the risk of misinformation and poor decision-making. Carbon credits and green initiatives are no longer distant policy discussions. They are active financial forces shaping the U.S. economy and influencing everyday American life. From inflation and interest rates to housing, jobs, and investments, the cost of carbon is increasingly reflected in personal finances. Understanding these mechanisms allows Americans to better anticipate risks, evaluate opportunities, and make informed financial decisions in a changing economic landscape. As the transition continues, those who recognize how sustainability policies translate into dollars and cents will be better positioned to protect and build long-term financial stability.